Hi, for our last session tonight, we'll have Milan Zdravkovic, who is the research lead at Zen Pulsar. Milan talks about, can memes beat the market using social media sentiment to forecast stocks returns? Delves into intriguing intersection of finance and social media. He'll explore how the sentiment analysis is being used to forecast market trends, particularly in cryptocurrencies. Let's welcome Milan.
Thank you so much. Okay, let's see how's this going to work out, because I just had a talk on energy management, so it's going to be quite different. I'm coming from academia. I'm working as associate professor in faculty of mechanical engineering. But I have my own boutique consultancy working with on different problems. Actually, my experience in working with time series analysis and machine learning with time series models led me to this contract, and we worked on quite exciting projects for 2 years already, and we are continue to work solving and addressing different kinds of problems. Essentially, we want to see at the future. Essentially, we want to predict the market movement and market dynamics. And I'm going to talk today about how we used social media data in doing so. So it's like a road not well beaten. I mean, there are many researchers in this area. There are many hedge funds and other finance institutions working on this, but that's something new, and that's something that we want to stay on the top of the wave with the Zen Pulsar, of course. I'm going to start with something that says that future cannot be predicted, and it's pretty much an old statement formalized by something called efficient market hypothesis. And I mean, you can basically predict stock prices, because at the point of trade, everything that happened in the past was already embedded. So that's nothing that you can do in the future to predict it. Normally, I mean, stock price goes like a geometrical Brown in motion. So it's the most complex signal that you can find in the society, nature, economy, or whatever. And that's why it's so difficult to predict. But makers of efficient market hypothesis left some space and said, okay, there are a couple of forms of this hypothesis. So we can say there is a strong or semi-strong and weak. Strong market hypothesis said that that's it. Everything that happened in the past is already embedded in the price. There is nothing that you can do to beat the market. There's nothing you can do to forecast what's going to happen in next time point. Semi-strong is not so rigid. It says, I mean, everything that happened in the past with the signal, and also publicly known information was embedded in the price, meaning that if there was something that happened on the market, in the companies, in industry, in science regarding some particular stock, and that's private, is not embedded in the price. So insider information is not embedded in the stock price. And I mean, strong hypothesis says that everything public and private information is already embedded in the price. But there is some statistical potential to explore this signal. And there are a couple of methods that you can do. If you are in computational finance, you already know about the technical and fundamental analysis. There are many more. And also when you look at the distribution of the stock price, actually relative return, and you will see that they are normally distributed. Normal distribution of the signal is something that goes a lot in nature and the economy and society, and that's something that you can see a lot when you talk about data. And when you have this kind of distribution, you can always say there is a hope. And especially when you say that when you consider this signal, you will see that there is something called fat tail distribution, meaning at the boundaries of this normal distribution, there is like a bump, sometimes even a bump, meaning that excessive returns, being at failures or successes on the market, are possible and more common than not. Okay, so how actually industry deals with the market forecasting? Normally they take very simple statistical tools like technical analysis. Technical analysis looks at the signal in the past and identifies trend, it identifies momentum, it identifies volume, and identifies volatility of the price. All those things can be easily mapped to statistical functions that you can use to do a lot with this. And if it's possible, I mean, there is a statistical tool. How many of you know machine learning and statistics? And Okay, very good. So, so I know in which level of detail I go, and there is a fundamental analysis dealing with intrinsic value of the stock with the real worth analysis. What's common and what's normal and very often in industry is analysis of news and media data. You have Bloomberg, this dashboard. You have many other software that can analyze in real time news data, and you then there are tools which can slice the news into insights, and then those insights you can take and you can submit it to some ChatGPT API or Mistral API or whatever, so to get information whether the market on specific stock is bullish or bearish. You can do that absolutely, and it works, but the thing is that everybody sees this news and it's easy to process. Once it's published in a reputable journal or some reputable website, it's available to everyone, and everyone will react to this news, so you don't have time to respond to this kind of change. So practically it's already embedded in the price while you are thinking of starting a trade. So what's not embedded in the price? Let's think about the sentiment of the market. It's like emotional category. It's something that's not so tangible, at least does not sound tangible. Let's think about the things that people know and that are not yet well known. It's not insider information. It's like some very loosely connected advances in scientific field or something like that. Where you can find this, you can find it on net, of course, but one place to look for, because it's easy to process and it's all structured information, is social media. So because people will talk about this, and this is some source of information that maybe you can use to establish somehow this overall sentiment market towards a particular stock. So our research hypothesis here, because this is research. We did not do like a product that people can use and get rich. The moment we do that, there will no be talks on the conferences. Rest assured about this. Our research hypothesis is that we can somehow build some aggregate sentiment by using social media data and use this sentiment as a predictor for the market price. And why this in parentheses? Why selected stocks on Asian markets and cryptocurrencies? Because if you take a look at the most popular stocks and the most liquid companies, you will not be able to beat the market because there is a lot of competition. And basically what we want to look, first of all, are the financial assets about which people talk on social media, and that's cryptocurrencies. And I will show you later on why Asian markets specifically. What are the current challenges? And people work on that. That's nothing new. And you can find a lot of articles in scientific literature. You can find a lot of white papers and things issued by the companies, but not of really immense value. Social media is indeed used as a source for market decisions now, but the thing is that you can use this, you can use the sentiment totally expressed by the individual investors. When you look at the markets, there is only Chinese market which has more than 70% of individual investors. In other markets, it's mostly establishments like hedge funds and big companies, investors. So they do not talk on social media about this. But in China, it is possible because 70% of individual investors, that's huge. That's already a lot of volume of data that you can try, with a high level of confidence to use in these kind of models. Most of the published research works currently use data from Twitter. Twitter is not good social media, because it's general purpose. It's very difficult to get proper selection of content, especially when you come to for example, especially when it comes to commodities. Because when you look for iron, when you look for copper or whatever, you will get tons of completely unrelated information and social media posts which are not related to market dynamics. Which is not the case with Twitter, because in Reddit, because on Reddit you have subreddits, and on subreddits there are specialized subreddits for some specialized things, and you can find very nice content there and very easily extracted without need of any filtering or discussing confidence at all. Most of the research work performs experiments by using a few popular US stocks or cryptocurrencies, especially those so-called meme stocks. You can, when you take a look at scientific literature, you can find papers they did 1 stock, 2 stocks, 5 stocks at the tops, and most liquid stocks. And of course, they report success because nobody reports failures. Another problem in AI today, which we discussed a lot today, is this survivorship bias, in which basically puts you in position to read, to failure information not be accessible to you. Because, and that's even more important than successes, because information about the failures tells you about where not to go, and that's very good information if you have limited research budgets or whatever. All researchers use only sentiment and not other properties of social media. Normally, they take posts and they use some sentiment classification algorithm based on some large language model or whatever. Now they're using APIs and it's much better. But you don't deal with the credibility of accounts. You don't deal with authenticity. You don't try to uncover if the account publishing specific tweet is bot or not bot, how credible, how authentic is the source. It's something that is more difficult to do, but it's possible to be. I mean, it's like not over difficult to do this. Actually, researchers do not that because normally they want to report only some immediate results. Commonly very simplistic approach to feature engineering, and research is normally not applicable in practice because of the fact that you create black box models. My biggest challenge in these 2 years of leading this team working with this sentiment analysis is how to gain the trust of investors. It's not machine learning models, it's not like feature engineering, it's not data acquisition, it's trust. Because nobody wants to buy something and if they don't know how it works. I mean, if you take like a LSTM network, very complex one, or you take like a transformer-based, sometimes serious forecaster or whatever, and you put it at the table when you discuss with investors, they will not buy it simply, because it's over complex for them. They don't want to know anything about this. So we took another approach. We start discussing about correlation, and we start about showing the tangible evidence that those signals can be used in forecasts, that they are good predictors. And then we leave the strategies to the clients, to the actual investors. What we did actually is that in this specific experiment, I want to report today actually 2 experiments. We got information from 2 social media networks in Taiwan and Hong Kong, so Asian stocks. And it was about 14 assets, not too many data points because those we don't want to work with most liquid assets because for the reason I already explained. And also I want to report about the results we got working with cryptocurrencies. In this case, the source was Reddit or selected subreddits from which we collected social media posts. In this case, we got more data points, more than 13,000, which is still not a lot, because when you talk with quants, when you talk with investors, they think in years. So if you want to show and demonstrate some prediction model or some correlation or whatever, they ask for 10 to 20 years of data. You can't have that with social media, because it's a relatively young thing when considering this period. So we did some data preparation, lots of analysis of association related to cross-correlation and causality when we use Granger coefficient. I mean, when you get into this, you realize very fast, very soon, that using basic statistical tests will work very well. Because, I mean, the signal is so complex that if you bring additional complexity by using very complex models or methods or approaches, you will end up with the over-optimizing, and you will end up with this, optimization will lead you to the bias of getting the good results with a test data set, commonly known as overfitting phenomenon, and then when it starts working in operation, that's not good anymore. Of course, from the point of view of the company, that's good enough, because you're there to show to your investors that that works, and that's already something that triggered their minds on how they can use this data afterwards. Then training and optimizing machine learning models with social media sentiment features and technical indicators data for predicting return direction in next time step. As objective function, we use normalized return of investment. We use hourly time series in this case, so it's quite complicated because it's not so easy to do intraday trading, and very few companies are doing that. But as I said, what we want to show is the potential, the value of data, not how to earn money. So this is why we also used one experiment for showing this evidence called vectorized backtesting, which is not possible to implement in real life, meaning trade on every time point without any transaction costs included. So basically just showing the value of data, not showing how to trade. And also, this is how we calculate the sentiment. It's one way. The strongest signal is this one. It's like natural logarithm of division of number of bullish and bearish posts in the past hour. Why logarithm? Because it favorizes bullish posts. And why is this important? Because in general, sentiment on social media is in overall bullish. And the market decrease cannot be so easily recognized, just because of that. I mean, there is a lot of hype on social media on one hand. On another hand, people tend to talk more about their successes than about the incoming failures or doom and gloom scenarios. So this is the reason why this specific feature was used, and it was proven in practice as the best solution. It's not only one. Yeah. Uh-huh. Okay, in this case, market close price is this signal, this red one. It's probably smoothened, and it's time series. Those on the x-axis is time.
The closing price and
the price, yeah.
Okay, thanks.
One moment.
So specific about the logarithm.
Okay. Sorry, just to see. Okay. No, I mean red one is the price is in gray, and this is sentiment. The red signal is sentiment here. But there are many other signals, as you can see here. We tried many. This is for Bitcoin. We use different strategies, some non-machine learning strategies, feature-driven, where we used individual combined social media signals to trigger long and short orders in the back test, only social media signals. But then also we use gray box hybrid strategies. Why? Because quants do not trust per se to these signals, so we want to combine it with a signal they know. It's like a trend signal or momentum or whatever, and then we combine it, and we do some simple voting based on the like summarizing the decisions proposed by the social media signal and the signal coming from technical indicators. When we did backtesting with the machine learning models, we got good results in vast majority of the assets. It's not a lot of, it's not a big success in this case, only 10 to 20% over the buy and hold. You can see some of the plots on the right. When we did backtesting on individual signals, so not machine learning techniques, we got some similar results. If you want, we can go in detail afterwards on these specific strategies, but this is maybe the most important conclusion with the cryptocurrencies. It worked very, very well. On portfolio of those assets, as you can see here, we got some relative normalized return of investment of 6, which is like a 600%. So it was quite good thing. So to conclude, at least this first part before we start with the questions and discussion, it works. It works many times. I cannot say that it works always. It works on test data set. It works on vectorized backtesting, all disclaimers. So it's up to actual investors to build a strategy which will exploit this evidence that this data is relevant for predicting the future in this case. Social media volume, not reliable feature. Lots of researchers are working on this. So if you talk a lot about something, it does not mean anything. It does not mean that it's bullish or bearish signal. Don't look at Twitter data. Twitter is completely unreliable. And first of all, you cannot get good filtering. You cannot do a nice data acquiring, data you want with a good distributions and relevance. Work with the Reddit, work with some obscure social medias like this in Asia. Assets with medium liquidity are the best candidates. That's something that I already mentioned a couple of times. Log transform works the best. Approach to sentiment classification has significant impact. How you do the sentiment analysis is important. At the beginning of this project, we started with using BERT. I mean, that's like ancient times for LLMs, and BERT as a specialized model, and we did some weak supervision, we did some fine-tuning on this, and it worked as it worked at that time. But as soon we started using OpenAI API, it worked much better. So this, their sentiment classification model worked much better than anything else. Currently, we are using also Mistral in-house on our own computational facility, and it also show good results. And also, to conclude, that's not one solution that fits all the assets, and dynamic modeling per asset per period is a must, meaning that every time point our models do hyper optimization in the past with a rolling window of 1 year or whatever. Actually, with all data we have, because we retrain our models. Before we retrain our models, we do the optimization of the parameters for those non-ML models. So, and after during this process also we do optimization of hyperparameters of machine learning models. Just for machine learning geeks, LSTMs, transformers, all this shiny new stuff cannot beat XGBoost. XGBoost is the mother of all algorithms, definitely, and it worked well also in this area. So thank you for this, and if you have any questions, I'll be happy to reply.
Thank you. I think you mentioned 1,300 or 13,000 of Reddit data points. My question is, are these the 1,300 posts or 1,300 users, and how have you picked them? Manually, I guess?
It's 13,000 hours. That's data point. Data point is hour, because that's time series. And for each hour in these 30,000, we know the number of bullish and bearish posts for each of the assets used in the experiment.
Okay, thanks. How these Reddit posts are classified?
At the time, this is old stuff. We did that at the beginning, and we used BERT as for the sentiment classification. It's either bullish or bearish towards specific asset. Now we are using, but we did not do for crypto, we didn't do for our other assets, we use OpenAI API. So we just make prompts, we submit a full post, and then we get in JSON, it's either bullish or bearish, and that's it. With some confidence levels, it's not simple as that. We do some other stuff.
Yeah, okay. And can we give us some details about the calculation of the sentiment, the equation you showed in a slide?
This one?
Yes, this one.
I mean, it's straightforward. I mean, you divide you get a ratio of bullish towards bearish posts, first of all. So it's going to be, if there are more bullish posts, it's going to be larger than 1. If it's less, it's going to be from 0 to 1. This 1 is in order to avoid division by 0. It's only reason, nothing more than this.
Yeah, okay. So N is number of posts.
N is number of bullish posts. BU is number of bullish posts.
And bearish, yes.
BE is number of bearish posts.
In a time period, right?
In a time period, yes.
Okay.
if I remember well, I mean, that was old one. I think, yeah, we did also some rolling sums, you know, to what we did. Okay, so
Yeah,
for
yeah.
the past hour, there is a number, but we also did weighted rolling sum, you know, just to keep the effect of the previous hours. You know, because sometimes it's relevant. It's easy for crypto because it's traded 24 hours. For this Asian market, it's traded also 5 hours, only 5 hours. So basically, what happens on social media, number of hours before the market opens, is important. You know, but then we somehow do like degradation of this signal, you know, because what happened hour before is more important than what happened 5 or 6 hours before. And this is why weighted rolling sum.
Yeah, thank you.
Thank you for the presentation. Just a quick one, maybe I missed it. Why did you use the Asian stock market? Have you tried with the US stock market?
We use Asian stock market because we had high hopes in it, because on those markets there are more individual investors than in other markets. When I say individual investors, I mean people like me and you. I mean, in US stock market, there are more, I mean, trading volume is brought basically by hedge funds, by established investors, which is not the case in Asian market. There are lots like of people like you and me that likes to brag about our trades on social media.
Okay, and on those Asian ones, you picked the most liquid ones,
We picked mid-liquid stocks, not the most liquid ones,
okay.
Because the most liquid ones are has the strong efficient market hypothesis. They're in the spotlight.
Thank you.
So market respond fast to any changes. So this is why we picked mid cap.
Thank you.
I have another question here up front.
Yeah, so I just wanted to quickly understand. So now, is this method also already, and this information embedded in the market? Because, yeah, because you said it's successful, it has, I guess, some predicted power. So I'm just trying to understand.
Well, you know, I mean, how quants are working, they all have some trade secrets and some formal methods to express their understanding of the market dynamics, which they adopt as eternal true, and they count on that this will be successful in the future. This is only one another set of data that you can use in this consideration. I don't want to step on any toes. I'm not from finance, so I cannot tell you how they will use this data. Our role was to show that this data is useful, and that's where we stop. And it appears as useful, and that's evidence. That's how we created this evidence. So here you go. I mean, it's up to you to use it or not. We have clients, I mean, companies have clients, and they're using it mostly in on experimental stage, at least that we know. So we don't know actually exactly know how they use our data, but we have some happy clients so far. Whether they are successful with it or not, I cannot tell you because I don't know.
Okay.
I mean, nobody from company knows, actually. It's very, as you know, it's very secretive. I mean, we did models on commodities, for example, and it was a fuck up. I mean, it didn't work at all. You know, with commodities, probably most difficult to work with. And there was like a Viber. I mean, as I said, I don't want to step any toes. I'm engineer. I don't work in finance. And I was told, and there was like a story and very big fuss about it, that there is a Viber group of investors where you can join, but you have to pay 50K, 50,000 euros to get into this group to get tips for trading on commodities. So it's very secretive in industry. It's not only about knowing the events, knowing the data, but some much more complex stuff.
Okay, thank you.
I didn't completely get the evaluation. You evaluated it for like how far like for short-term trading, medium, long?
Okay, so I understand the question. So vector, I didn't want to get into too much technical details, but I can go with it. So you have 5 years of data, and there, let me show the simplest test. This is the simplest one, but we had more. Then you take 4 years and you train the models with that, and then you test on this 1 year. So model did not see anything from this 1 year. So you have to be very careful. It sounds like an intuitive thing, but it's not so easy to do, to keep your hands away from the future. To build the models and to do feature engineering, that's the trickiest thing, that doesn't have this lookup bias. So you move this 1 year, and then you use models to predict stuff on this 1 year. And then you just look at the performance. You look at the return at the beginning, at the end. This is buy and hold. And then you look how your algorithm performs every hour you buy or sell based on the recommendation of the model, and that's it. And at the end, you have this normalized ROI as the final metrics.
So your algorithm gave, like for very short periods, gave the information if you should buy or if you should sell.
That's vectorized.
And you did that for the whole year?
Yes. That's vectorized backtesting. You trade at every time point. Okay. This is why I said it's not possible. I mean, it's not real life. But it shows you how, if the data is good or not.
Okay, thank you.
Yeah.
Question from me. So how many data points from the past did you use? I didn't completely understand this. So you have many data points, sentiment data points from the past, and then how many of them do you use at once, like to predict the output?
You see here, there's a 13,000 data points from cryptocurrencies. That's the only one. We did hundreds of experiments, with different of time ranges, data spans. You know, for example, you don't have access to some stock data because the company was established 3 years ago, so you don't have data about anything before that. So this is why it's more difficult, for example, to work on portfolios. So you have to select the stocks which are like a long-term, that they exist for quite a long time. But then you also have to be careful not to go into deep past with the social media, you know, because social media was not so used, it was differently used at the time. So this is also this factor of changing dynamics of social media. And these are the numbers you have on this screen here. So 13,000 time points, I don't recall how many months or years is that for Reddit. Normally we take like 2/3 or 3/4 of data for the training and 1/4 for testing. But also we have other methodologies like a walking test. So it is a little bit more different. I don't want to go into that, you know, because this was, in this area, you use the simplest stuff the people from the investors can understand. I mean, if you go into too complex things and even start explaining, the conversation ends. You know, even if it's not the best way, do this like this. So this train test split is the simplest way, and this is why we used it.
All right, thank you.
Yeah, actually not a question. I just want to add my 2 pence on predicting commodity returns using sentiment analysis, because I had to do it like 5 years ago when my company asked to find the right moment to set the future price for the electricity of the company was buying. And we tried to use to add as predictors sentiment classification based not on social media data, but on web data, news data about electricity. And it was really hard to gather this data because there's not so much content about this, specifically for electricity. We spent around 2 months doing this, and at the end we built a crawler, a scraper that automatically goes to like 20 sites that talked about electricity. And we gather all this data, we classified this data, this news.
For sentiment?
For sentiment, yes. and at the end we were not able to find relations between prices going up or down and news. So yeah.
This is the most secretive. Commodities, you know, is the most secretive sector on market trading. So it's very difficult to build models. And the less democratic, let's say.
Yeah.
People on social media do not buy futures. I mean, they are.
Yes.
It's simple as that.
Okay.
Is that it? I guess. Any more questions? Milan, thank you again.
Okay, thank you.
We'll see you next year.
Thank you so
Also,
much.
thank